Adrian Mowat, Chief Asian and Emerging Equity Strategist at JPMorgan, joins in now to talk about all that and more. Adrian, hi, good morning. Good to see you. And as always, what's the expectation from the Fed Reserve meeting this time?
I think there's two key things we're expecting. The first is that they will finish QE3, so the final sort of 15 billion of asset purchases will be completed, and that they won't continue. There was some confusion around that with the St. Louis president suggesting, this is Bullard suggesting that they maybe should continue it, but we don't see any other support within the Federal Open Market Committee for them doing that, particularly as the macroeconomic data is basically tracking what they were expecting. The other key item to look out for is the wording with regards to interest rates, and we still expect them to maintain the zero interest rates for a considerable period of time. So that language will be seen as important for the market.
Okay, so you would expect that the bond purchase will be stopped in this policy statement, Adrian. What will be the nuances that you will watch out for in terms of the wording?
Well, the wording is whether they continue to use considerable time when describing keeping interest rates low. Remember that the start of the weakness in markets that we saw in early September was running into the Federal Open Market Committee meeting, where the market was speculating that they might remove that phrase. And that initially caused markets to be concerned, the dollar appreciation to accelerate. And then as the month moved on, we seemed to start to worry about other things, such as European growth, a falling oil price being evidence of weak growth rather than just plentiful supply. So I don't know whether we're sort of doing a full circle here from the meeting 6 weeks ago, but my suspicion is that we'll look at this event, we'll look at what the Fed says, and we'll decide not much is changing, and probably we've got very low interest rates for a very long period of time.
Okay, you would not expect new phrases or concerns to make their presence. For instance, Stanley Fischer referring to the strength of the dollar specifically. Anything like that would make its presence felt in the Fed's language or statement?
Well, I mean, if it does, then that would be market positive. What Fisher was referring to was potential external weakness due to dollar strength and also a weak European economy. And that would argue for a delay in the increase in interest rates relative to not having those negative external conditions.
What is your view on the Indian market now, Adrian? Because in the last couple of weeks, we've seen a spate of tough reforms undertaken by the government, whether it was diesel deregulation, whether it was the gas price hike. Would you add more money into the Indian markets now?
Yes, we would. And this is today we had the results of the Brazilian presidential election. We had been hoping for a more constructive policy environment in Brazil. That's not going to come through, we believe. So we have downgraded Brazil from an overweight to a neutral. And we would advocate people taking that capital and investing in the countries that are big beneficiaries of the decline in oil price. So the countries we would particularly highlight would be India, Indonesia, and Thailand within the Asian region. Add to that India getting a benefit from inflation through a more productive way of dealing with the agricultural sector. I can see agricultural inflation coming down quite a lot in India. Plus, we've got a reform momentum that the investors were getting a little bit cynical about prior to Prime Minister Modi's return from his foreign trips.
Yet we've seen FII flows almost plateauing, and even some large days of large sales in October itself. Do you see this phase playing itself out and more money flowing in November?
Yes, it's always very important to put Indian flows into context of the broader emerging market flows. We've seen an increase in volatility in both bond markets, equity markets, and currency markets. When that occurs, people tend to sell risk assets, including emerging market equities. And we have seen strong outflows from emerging market mutual funds and ETFs. And I think India has actually done relatively well against that quite powerful negative tide.
So, since you have recommended putting more money into the Indian markets, what would the sectoral preference be now, Adrian?
Okay, so we've seen an outperformance in the last couple of months of the external sectors such as IT plus pharma, so a more defensive bias to outperformance. We think with what's happening with the reduction in inflation gives you a more attractive environment for interest rates and cyclical stocks. So we're pushing the banks, and we continue to advise investors to look at some of the cyclical names, particularly those that have pulled back from the peaks that they reached a few months ago.
Barring one, most of the big IT boys actually underperformed market expectation. Do we see you actively taking money out of IT and putting money into the sectors you just spoke about, the cyclicals?
Well, I think there's a context here. For me, in a global emerging market portfolio, the Indian IT names still look very attractive. But I think if I was running just dedicated Indian money, then yes, absolutely, we would be making a sector shift out of pharma and IT into some of the more cyclical names. Our preference would be near cyclicals like the banks, but we would also be looking at the consumer names. I think you had a session on two-wheelers prior to me speaking, also the auto companies. You may also want to look at some of the building material names as we move into a year where we would expect the Indian economy to be picking up pace.
So what kind of returns do you think this market can deliver from now up until the budget, Adrian? We've already put in about 27% since the start of the year, but since you are recommending more investments into India, do you think we could replicate that return in the next 6 to 12 months?
I think you could get 20% plus returns out of the Indian market. That would certainly be consistent with our broader emerging market call and the fact that we're overweight India.
Okay, well, the other big trend that has been pushing up Indian markets has been the kindness in the prices of crude. We've seen some dramatic falls there. What is the in-house view at JPMorgan? Do you expect it to continue to remain soft for a better part of 2015? And how will that determine your stock selection as well as country allocation?
Yeah, so we would look for crude to basically be tracking the forward curve. So we don't see further weakness, maybe a slight drift higher, but it's still a very advantageous environment for India and many other emerging economies, as it is for the developed world consumer. So this is a very important dividend coming through. There is potential downside risk to crude. If you look at the magnitude of the increase of U.S. production over the last 7 years, it is quite substantial. That increase in production is equivalent to most OPEC producers. I think people are underestimating just how important that's been. We're also seeing a lot of technology changes at work, which is in particular making vehicle fleets a lot more efficient. So we're broadly constructive in the idea that oil can stay at these levels, and perhaps there is a little bit of downside risk.
So, just one final comment on the market itself. You did mention a 20% growth that you're expecting on the index, but do you get a sense that mid-caps could outperform? Because we've seen a huge outperformance from mid-caps since the start of the year.
I always find sort of stating, whether mid-caps can outperform is a difficult one. It rather depends on the sector composition within the countries of the mid-caps. I think there are going to be risk-on attitudes in India, which tends to favor small and mid-caps if they're trading at discounts, but also give you the added risk of less liquidity. So, I'm very open-minded to buying these, but they need to be in the right sectors and they need to have the right earnings revisions.
All right, we'll leave it at that. Adrian Mowat, pleasure speaking with you as always. Thank you very much for joining us.
Thank you.